Stop everything right now. Close every other tab. What I'm about to tell you in the next 30 minutes will fundamentally change how you view the silver market forever. While you were sleeping last night, between 1:47 a.m. and 4:22 a.m. Eastern Time, something extraordinary happened that the mainstream financial media will never report. Sovereign wealth funds from 3 different nations executed coordinated physical silver purchases totaling just over $10 billion in actual metal, not paper contracts, not ETF shares, physical deliverable silver. And they did it in a way that bypassed every single reporting mechanism that normally triggers alerts at the CFTC. I have in front of me right now a leaked internal settlement document from a Tier 1 bullion bank. I'm not going to tell you which one because I value my sources, but this document shows wire transfer confirmations for emergency liquidity requests to 3 separate refineries, 2 in Switzerland and 1 in Singapore. The amounts are staggering. We're talking about requests for immediate delivery of 47 million ounces from refinery stocks that were supposed to be allocated to industrial contracts already on the books. Someone with nation-state level resources just jumped the line, and they paid a premium that should terrify every single person watching this video. The average premium over spot on these transactions was 14%. 14%. You need to understand what that means. When a sovereign buyer is willing to pay 14% over the fantasy price you see on your screen right now, they know something you don't. The price you see on the screen is a lie. That number, whatever it is when you're watching this, represents a synthetic derivative market that has been mathematically decoupled from physical reality. Let me be very clear about something. The spot price of silver is determined by the futures market, specifically the COMEX, where the vast majority of contracts are settled in cash, not metal. It's a paper price for a physical metal, and that contradiction is about to detonate. Now listen to me very carefully because this is where it gets serious. I pulled the Commitment of Traders report from last Friday. The commercial short position, that's your JP Morgans, your Citigroups, the bullion banks that have been suppressing this market for decades, that position decreased by 11 zero contracts in 1 week. 11,000 contracts. Each contract is 5,000 ounces. You do the math. That's 55 million ounces of short covering in 1 week. But here's the part that should make your blood run cold. At the exact same time, the registered inventory at COMEX, that's the metal actually available for delivery, dropped by 22 million ounces. The metal is vanishing from the vaults while the banks are scrambling to cover shorts. These 2 data points happening simultaneously is not a coincidence. It's a controlled detonation. I've been doing this for 23 years. I've seen manipulation, I've seen interventions, I've seen coordinated attacks to shake out retail investors right before a major move up. But what I'm seeing right now is different. This is capitulation. The banks know they've lost control of the physical market, and they're trying to exit their short positions before the people who actually own the metal figure out what it's really worth. Let's talk about who these sovereign buyers are, because this is not some internet rumor. At 2:17 a.m. Singapore time this morning, which was yesterday afternoon on the East Coast, the Monetary Authority of Singapore published and then immediately deleted a reserve diversification memo. It was live on their website for exactly 14 minutes. I have a screenshot. In that memo, they explicitly reference increasing strategic metal reserves with a focus on silver due to what they call energy transition supply constraints and monetary debasement in reserve currencies. They deleted it, but the internet is forever, and that document is now circulating in private circles among people who understand what's coming. 48 hours ago, the Saudi Public Investment Fund, that's PIF, the same fund that bought LIV Golf and owns a piece of everything from Uber to Lucid Motors, they announced a joint venture with a mining consortium to develop 3 silver projects in Argentina and Peru. The announced investment is $2.4 billion. But here's what they're not telling you. Embedded in that announcement, if you read the footnotes, and I mean really read them, they've also secured offtake agreements for 100% of the production for the first 7 years. 100%. They're not developing these mines to sell silver on the open market. They're developing them to ensure their own supply because they know what's coming. The Saudis are not stupid. They've been on the wrong side of dollar debasement before, and they're not going to get caught again. Then we have the situation in India. 3 days ago, India's central bank, the RBI, quietly revised import duty structures on silver bullion, dropping tariffs from 15% to 7% for a so-called trial period of 6 months. You don't just cut import duties in half on a strategic commodity unless you want a lot of it coming into your country very quickly. Within 72 hours of that announcement, Rotterdam reported a backlog of container shipments destined for Mumbai, specifically flagged as precious metal cargo. We're talking about an estimated 340 tons of silver that just started moving east. That's roughly 11 million ounces that were sitting in European vaults and are now on ships heading to India. You're starting to see the pattern here. Sovereign entities, nations, central banks, wealth funds, They're all moving at the same time, and they're doing it quietly, but not quietly enough. The footprints are everywhere if you know where to look. Now let me show you why the math is completely broken, because this is where it gets really ugly for anyone who doesn't own physical metal. Global silver mine production in 2024 was approximately 830 million ounces. That's the total new supply coming out of the ground from every mine on planet Earth. Of that 830 million ounces, about 72% comes as a byproduct of mining other metals like copper, lead, zinc, and gold. That means primary silver mines only contribute about 230 million ounces. This is critical because you can't just turn on more silver production when the price goes up. If you're a copper miner and silver is a byproduct, you're mining for copper, not silver. The silver comes along for the ride, but you're not going to increase your copper production just because silver prices doubled. So we have 830 million ounces of new supply per year. Let's be generous and say there's another 200 million ounces of recycled silver that comes back into the market from old electronics, jewelry, scrap. That gives us a total annual supply of about 1.03 billion ounces. Now let's look at demand. Industrial demand alone, and I'm talking about solar panels, electronics, batteries, EVs, medical applications, water purification, 5G infrastructure. That industrial demand was 556 million ounces last year. Investment demand, your bars, your coins, your ETFs, that was another 267 million ounces. Jewelry and silverware took about 203 million ounces. Add it up, we're at 1.026 billion ounces of demand against 1.03 billion ounces of supply. You see the problem? There is no buffer. There is no safety margin. The market is already balanced on a knife edge, and that's before we talk about what just happened in the last 72 hours. If sovereign buyers just pulled $10 billion of physical silver out of the available supply, we need to do the math on what that means. $10 billion at, let's call it $32 per ounce because we know they paid a premium that's 312 million ounces. You just took 312 million ounces out of a market that only produces 830 million ounces per year. You just removed more than a third of annual mine production in one coordinated move, and you did it in 72 hours. But wait, it gets worse. That 312 million ounces didn't come from this year's production. It came from existing stockpiles, from refinery inventories, from allocated storage that was supposed to supply industrial users who have contracts. Someone just cut in line, and the people at the back of that line are about to realize there's no metal left when their number gets called. I want you to think about something. Samsung, Apple, Tesla, Panasonic, LG Chem, every single major electronics and EV manufacturer depends on silver. A Tesla Model 3 uses between 18 and 25 grams of silver. Doesn't sound like much until you remember Tesla wants to produce 20 million vehicles per year by 2030. Let's use 20 grams as an average. 20 million vehicles times 20 grams is 400 million grams, which is about 12.8 million ounces per year just for Tesla, one company. Solar panels use about 20 grams of silver per panel. Global solar installations are projected to hit 400 gigawatts of new capacity this year. Without getting into the weeds on panel efficiency and silver loading per watt, we're looking at roughly 140 million ounces of silver needed just for solar this year, and that number is growing at 15% annually. Now add the new demand that nobody's talking about, silver zinc batteries. You heard me right. There's a company called NZinc that just secured a $1.2 billion Department of Defense contract to produce silver zinc batteries for military applications, specifically drone warfare and portable energy systems for forward operating bases. The silver loading in these batteries is substantial. We're talking about 65 grams of silver per kilowatt hour of storage capacity. The initial production target for this DoD contract is 18 gigawatt hours over 3 years. Do the math. That's 1.17 billion grams of silver, which is 37.6 million ounces, just for one military contract that was announced 6 days ago, and I guarantee you didn't see it on CNBC. Here's the kicker. I spoke to a contact who works in procurement for one of the big 3 automotive suppliers. He told me, off the record, that his company just received force majeure notices from 2 of their silver suppliers claiming they cannot fulfill Q3 and Q4 delivery contracts due to upstream supply constraints. Force majeure, that means an unforeseeable circumstance that prevents someone from fulfilling a contract. You know what that tells me? It tells me the refineries are out of metal, or the metal they have is already spoken for by someone who paid more and got priority. This is what a supply shock looks like in the early stages. It doesn't start with the price exploding. It starts with quiet phone calls, delayed shipments, force majeure notices, and premiums creeping up in the physical market while the paper price sits there like nothing's wrong. Let's talk about the enemy, because there is absolutely an enemy in this story. For decades, the bullion banks, and let's name them, JP Morgan, HSBC, Scotiabank, these institutions have been on the short side of the silver market. They've sold paper contracts representing silver they don't have, using the COMEX as a legal venue to suppress the price and control volatility. This isn't conspiracy theory. JP Morgan paid $1 billion fine in 2020 for spoofing the precious metals market. That's a matter of public record. They admitted to manipulating the market. The fine was the cost of doing business. But something changed. Starting in late 2022, JP Morgan began quietly flipping from net short to net long in silver. They didn't announce it. They didn't send out a press release. But if you watch the commitment of traders data every single week like I do, you can see the footprints. Over the course of 18 months, JP Morgan reduced their short position by an estimated 190 million ounces and simultaneously accumulated a long position in physical metal held in their COMEX warehouse. As of last month, JP Morgan's COMEX warehouse held 176 million ounces of silver. That's more than 20% of all the silver in all COMEX warehouses combined. Think about what that means. The biggest manipulator, the institution that spent decades keeping the price suppressed, has now switched sides. They're long. They want the price to go up. But they don't want it to go up in a disorderly way because they're still managing a derivatives book that could blow up if volatility gets out of hand. So what do? They let sovereign buyers take physical delivery at a premium, which drains supply and tightens the market, while keeping the paper price stable to avoid triggering a panic. It's brilliant, and it's evil, and it's happening right in front of us. Now let's talk about China, because China is always 10 steps ahead. In January of this year, the Shanghai Gold Exchange, which also trades silver, announced a new international silver contract settled in yuan with physical delivery in bonded warehouses in the Shanghai Free Trade Zone. The contract launched with minimal fanfare. Western media barely covered it. But here's what matters. In the first 8 weeks of trading, that contract has already seen delivery requests for 41 million ounces. 41 million ounces in 8 weeks. That metal is moving from London and Zurich into Chinese vaults, and it's not coming back. China's been very clear about their strategic goals. They want to reduce dependence on the dollar. They want to control supply chains for critical materials. Silver is both a monetary metal and an industrial metal. It's the ultimate dual-use asset. If you control the physical silver market, you control pricing for everything from solar panels to military hardware, and you undermine the dollar-denominated paper markets that the West uses to suppress prices. There's a term you need to understand: backwardation. Normally, in a commodity market, the futures price is higher than the spot price because of storage costs and the time value of money. That's called contango. Backwardation is when the futures price is lower than the spot price, which signals that people want the metal now, not later. It's a red flag that physical demand is overwhelming paper supply. Last Thursday, for a brief 3-hour window, the March silver contract on COMEX traded in backwardation. It corrected by the close, but the fact that it happened at all is a 5-alarm fire. Backwardation in silver almost never happens, and when it does, it means the market is broken. Let me tell you what I think is really going on here, and this is where you have to connect the dots across multiple markets. We are witnessing the early stages of a monetary reset that nobody wants to talk about publicly. The dollar is being systematically devalued through money printing. Inflation is not transitory, it's structural. Central banks around the world know this. They're trapped. If they raise rates high enough to actually kill inflation, they collapse the debt markets and trigger a global depression. If they keep rates low and print money, they destroy the currency. It's a no-win scenario. So what do you do if you're a sovereign wealth fund or a central bank, and you see this coming? You move out of paper assets and into hard assets. Gold, silver, oil, farmland, strategic metals. You do it quietly because if you announce it, you trigger the very panic you're trying to avoid. But you do it quickly because you know other nations are doing the same thing, and it's a race to secure supply before the music stops. That's what we're seeing in silver right now. It's not a speculation trade. It's a survival trade. These buyers are not trying to make 20% on a swing trade. They're trying to preserve wealth and secure strategic resources in a world where paper currencies are dying and supply chains are weaponized. Now let's talk about what they're going to do to you in the next few weeks, because this is important. The bullion banks and the financial media are going to try to shake you out. They've done it 100 times before. Here's how it works. The price will start to creep up. Silver will go from 32 to 34 to maybe 36 over the next couple of weeks. Retail investors will start to get excited. You'll see headlines about a silver squeeze. Then, out of nowhere, usually on a Sunday night when liquidity is thin, they'll slam the market. They'll dump 10,000 contracts in 15 minutes and drive the price down $4 or $5 in a matter of hours. It'll look like a crash. The financial media will say the rally is over, that silver is too volatile, that you should sell and move into bonds or dividend stocks, or whatever garbage they're peddling that week. Your brother-in-law will call you and tell you you're an idiot for buying silver. The price will sit there, depressed, for days or even weeks, and they'll wait for you to capitulate. That's the game. They need your metal. They need you to sell it back to them at a lower price so they can deliver it to the sovereign buyers who are willing to pay a premium. Do not fall for it. When you see that coordinated smash, that's not the market telling you you're wrong. That's the enemy telling you you're right, and they're desperate. Every single time they've done this in the past, the price has eventually recovered and gone higher. But the people who sold in panic never got back in, and they missed the real move. Let me show you what's different this time. In previous silver rallies, the suppression worked because there was enough physical supply in the vaults to meet delivery requests. If a few thousand retail investors wanted to take delivery, the banks could handle it. They'd scramble, they'd pay a small premium to refineries, they'd move some metal around, and the system would stay intact. But this time, the vaults are being drained by nation-states, not retail investors. When a sovereign wealth fund shows up with a $10 billion wire transfer and says we want physical delivery in 72 hours, you can't say no. You can't give them an IOU. They'll take their business to Shanghai or Singapore or anywhere else that has the metal. This is a wholesale market move, not a retail market move, and that changes everything. The bullion banks can manipulate the price on the COMEX all they want, but they can't create physical silver out of thin air. The retail investors, the people watching this video, you're not the primary movers in this market anymore. You're actually in a privileged position because you're small enough to act quickly and you're smart enough to understand what's happening. The sheep, the people watching CNBC and taking advice from their financial advisor at Merrill Lynch, they have no idea this is even happening. By the time they figure it out, the premiums will be 30%, and good luck finding metal at any price. I want to talk about rehypothecation because this is a term that should make you furious. Rehypothecation is when a bank takes an asset that a customer has deposited, let's say silver in a vault, and then uses that same silver as collateral for multiple different obligations. It's legal in certain jurisdictions, and it's absolutely rampant in the precious metals market. Let's say you buy a silver ETF like SLV. You think you own silver, right? You don't. You own a share of a fund that claims to hold silver in a vault. But that vault, operated by a custodian like JP Morgan, can hypothecate that silver. They can lend it out. They can use it as collateral for other trades. The same bar of silver can be claimed by multiple parties on paper, even though there's only one physical bar. This works fine until everyone wants their silver at the same time. Then you find out that the 500 million ounces the ETF claims to have is really only 200 million ounces of unencumbered metal, and the rest is tied up in obligations you didn't even know existed. This is why I say the price on the screen is a lie. The entire paper market is built on leverage and rehypothecation, and when the music stops, there will not be a chair for everyone. If you own silver ETFs, you don't own silver. You own counterparty risk. If you own unallocated silver in a vault, you don't own silver. You own a promise from a bank. The only way to own silver is to have physical metal in your possession or in a fully segregated, allocated vault where the specific bars are registered to you and cannot be touched by anyone else. Anything short of that is paper, and paper will burn. Let me give you a specific example of how this is playing out right now. There's a refinery in Zurich. I'm not going to name it, but it's one of the big ones. 2 weeks ago, they received delivery requests for 18 million ounces from 3 different clients, all of whom had purchased unallocated silver over the previous 6 months. Unallocated means the refinery owes you silver, but they haven't set aside specific bars for you. They're managing a pool. Under normal circumstances, the refinery would have 18 million ounces sitting in the vault, and they just allocate it, stamp the bars with the client's name, and ship it. But when they went to allocate the metal, they realized they only had 11 million ounces of unencumbered inventory. The rest had already been committed to other clients or loaned out to bullion banks under short-term lease agreements. So what did they do? They called the clients and offered them a 2-month delay in delivery in exchange for a 3% discount on the purchase price. 2 of the clients agreed. 1 did not. That one client escalated, threatened legal action, and the refinery had to go into the spot market and buy 7 million ounces at a premium to fulfill the contract. That premium came out of the refinery's profit margin, and I guarantee you they're not going to let that happen again. The refinery has now suspended all new unallocated sales and is only offering fully allocated purchases, which means you pay up front, and the metal is set aside immediately. That's a massive red flag. When refineries stop offering unallocated sales, it means they don't trust their own inventory system anymore. This is happening across the industry, and nobody's talking about it because it reveals just how fragile the whole system is. Let's talk about industrial offtake, because this is the slow-motion train wreck that's going to destroy the investment market. Industrial users of silver, the Samsungs, the Teslas, the solar panel manufacturers, they've operated for years on just-in-time inventory systems. They don't stockpile 6 months of silver. They buy what they need for the next 30 or 60 days, and they rely on the market to always have supply available. It's efficient, it's cost-effective, and it works great until it doesn't. Right now, those industrial users are waking up to the fact that the market is tightening and their suppliers are flaky. So what are they doing? They're stockpiling. They're breaking their own just-in-time models and buying 3, 6, even 12 months of forward supply to make sure they don't get caught in a shortage. When you have hundreds of industrial users all doing this at the same time, you create a demand surge that dwarfs anything happening on the investment side. I've seen estimates that if just the top 50 industrial users of silver decided to increase their inventory buffers from 60 days to 180 days, that would create immediate demand for an additional 200 million ounces. 200 million ounces. That's a quarter of annual mine production, and it would hit the market in a matter of months, not years. There's a company called First Solar, one of the biggest solar panel manufacturers in the United States. In their Q4 earnings call, which happened 3 weeks ago, the CFO mentioned in passing that they had increased their strategic materials inventory, including silver, to ensure production continuity. The analysts on the call didn't even ask a follow-up question, but I did. I reached out to a contact who works in their supply chain, and he told me they went from a 45-day silver inventory to a 210-day inventory in the last 4 months. That's one company. If this is the trend across the industry, and I believe it is, the available supply for investment is about to fall off a cliff. Here's the nightmare scenario, and I want you to understand this because it's not fear-mongering, it's math. Let's say sovereign buyers take another 300 million ounces over the next 6 months. Let's say industrial users increase their stockpiles by 200 million ounces. That's 500 million ounces of demand on top of the normal annual demand of 1.03 billion ounces. You're now at 1.53 billion ounces of demand against 1.03 billion ounces of supply. Where does the missing 500 million ounces come from? It comes from existing stockpiles. It comes from ETF inventories being raided. It comes from investors who panic sell when the price gets volatile. And when those sources run dry, the price goes vertical because there is no substitute for silver in most of its applications. You can't make a solar panel without silver. You can't make a high-end smartphone without silver. You can't make a guided missile without silver. It's not a luxury good that people will stop buying when it gets expensive. It's a critical input, and users will pay whatever they have to pay. We are entering the era of the real. I've been saying this for months, but it's happening faster than I expected. The era of the real means hard assets. Physical commodities, things you can touch, things that can't be printed or created with a keystroke. For decades, financial assets, stocks, bonds, derivatives have dominated wealth. But that era is ending. We're moving into a period where physical resources are the ultimate form of wealth, and the people who understand this early are going to experience the largest wealth transfer in human history. Silver is the play. It's not gold. Gold is for central banks and billionaires. Silver is for people like you and me who understand that it's undervalued, underowned, and absolutely critical to the global economy. The gold to silver ratio is still sitting at around 85 to 1. Historically, it's averaged 15 to 1. If silver just mean reverts to that historical average, and gold stays where it is, silver goes to over $170 an ounce. But I don't think gold stays where it is. I think gold is going to 3, 500, maybe 4, 0, and silver is going to outperform it on a percentage basis. You want to know why I'm so confident? Because the short interest in silver is still massive. The physical supply is draining, industrial demand is accelerating, and sovereign buyers are front-running the entire market. You've got a perfect storm of supply constraints, demand surges, and a discredited paper pricing system. It's not a question of if silver explodes, it's a question of when. And I'm telling you, the when is now. We're in the early innings. Most people won't realize what's happening until silver blows past 50. And by then, the premiums on physical will be so high that they'll be priced out. Let me tell you what to watch for in the next 2 weeks, because these are the signals that will confirm everything I've just told you. First, watch the COMEX registered inventory. If it drops below 40 million ounces, that's a critical level. We're at 54 million right now. If we lose another 14 million ounces in the next 2 weeks, the alarm bells should be deafening. Second, watch the premiums on physical. Right now, you can still buy American Silver Eagles for about $4 to $6 over spot. If that premium goes to $8 or $10, it means retail supply is tightening. If it goes over $12, it means we're in a shortage. Third, watch the Shanghai Silver Exchange inventory. If it keeps dropping while prices stay flat, it means China is absorbing supply and the Western pricing system is losing relevance. Fourth, and this is critical, watch for forced settlement announcements from ETFs. If you see an ETF like SLV or PSLV announce that they're suspending redemptions or switching to cash settlement, that's the canary in the coal mine. It means they can't get physical metal to meet redemption requests, and the game is over. I also want you to watch the behavior of the mining stocks because they're going to front-run the metal. Companies like First Majestic, Endeavor Silver, Mag Silver, these primary silver miners are going to start moving before the metal does because institutional investors know what's coming and they'll position in the equities first. If you see a sustained breakout in the mining stocks while the metal is still flat, that's your confirmation that the smart money is loading up. Now let's talk about what they're going to do to try to stop this. The COMEX and the bullion banks have a playbook, and they've used it before. In 2011, when silver ran to $49, the COMEX raised margin requirements 5 times in 2 weeks. They made it so expensive to hold a futures position that they forced liquidation and collapsed the price. They'll do it again. When silver starts to really move, they'll raise margins, they'll change the rules, they'll do whatever they have to do to protect the banks. But here's the thing. It won't work this time because the demand is not coming from speculators on the COMEX. It's coming from sovereign buyers in the physical market who don't care about margin requirements. You also need to be ready for a media blitz telling you that silver is in a bubble. They'll trot out analysts who will say it's overvalued, that it's moved too fast, that you should take profits. Do not listen to them. These are the same people who told you to buy bonds at negative real yields. These are the same people who said inflation was transitory. They are either incompetent or complicit. And either way, they do not have your best interests at heart. I'm going to tell you something that might be hard to hear, but it's the truth. The system is rigged. It's been rigged for a long time. The financial markets are not free markets. They're managed, manipulated, and controlled by a small group of institutions that have the backing of central banks and governments. They've been able to suppress the price of silver and gold for decades because it serves their interest. A rising gold and silver price is a vote of no confidence in the dollar and the entire fiat currency system. They can't allow that. So they've built an entire apparatus of paper contracts, ETFs, and futures markets to control the price. But that apparatus is breaking down. The physical market is overpowering the paper market, and there's nothing they can do to stop it without exposing the fraud. If the COMEX defaults, if they can't deliver metal on contracts, the entire game is revealed. They'll do everything they can to avoid that, but the math is working against them. Here's what you need to do. If you don't own physical silver, buy it now. I don't care if you think the price is high. I don't care if you want to wait for a dip. The dip might not come, and if it does, it'll be a coordinated attack designed to shake you out. Buy physical silver, take delivery, and put it somewhere safe. Not a bank-safe deposit box, because if there's a banking crisis, you won't have access. Somewhere you control. If you already own silver, do not sell. I don't care what the price does in the short term. They're going to test you. They're going to try to scare you. When silver drops 8% in one day on no news, that's not the market, that's the banks. Hold through it. The people who are going to make life-changing wealth from this are the people who have the discipline to hold physical metal through the volatility. If you're more aggressive and you understand the risks, you can play the mining stocks, but understand that they're more volatile and they come with company-specific risks. A mine can flood. A government can change royalty structures. A CEO can be incompetent. The metal doesn't have those risks. But if you're going to play the miners, focus on the primary silver miners and the developers that are close to production. Those are the ones that will see the biggest percentage gains. And for the love of God, do not buy silver ETFs thinking you own silver. You don't. You own a claim on a pool of metal that's probably been rehypothecated 6 different ways. If you want exposure and you can't hold physical, buy PSLV, the Sprott Physical Silver Trust, because at least they have a track record of transparency and they hold allocated metal. But even then, understand that you're still exposed to counterparty risk. Let me wrap this up because I know I've thrown a lot at you. But this is the most important trade setup I've seen in my entire career. We are at the beginning of a silver bull market that is going to be fueled by supply deficits, sovereign buying, industrial demand, and the collapse of the paper pricing system. The price you see on the screen right now is not real. It's a fiction maintained by a derivatives market that's about to be overwhelmed by physical demand. Sovereign wealth funds are front-running the banks. They're taking delivery of hundreds of millions of ounces, while the banks are still trying to manage their short positions. The industrial users are stockpiling because they see the supply chains breaking down. And retail investors, the people like you who have been stacking for years, you're about to be vindicated in a way that's going to shock the world. The mainstream media won't tell you this. Your financial advisor won't tell you this. The banks certainly won't tell you this. But the data is screaming if you know how to read it. The registered COMEX inventory is collapsing. Backwardation is appearing in the futures market. Refineries are suspending unallocated sales. Force majeure notices are going out to industrial users. Sovereign buyers are paying 14% premiums over spot for immediate delivery. These are not subtle signals. This is a market that's breaking in real time. Tomorrow, or maybe next week, they're going to try to smash the price. They'll dump contracts in the middle of the night when volume is thin. They'll trigger stop losses, they'll create panic, and the weak hands will sell. Don't be weak hands. Understand that every attack is a gift. Every manufactured dip is an opportunity to acquire more metal at a discount before the real move happens. The end game here is a silver price that's multiples of where we are now. I'm not talking about a 20% gain. I'm talking about a repricing of silver to reflect its true value as both a monetary metal and a critical industrial input. When that happens, and it will, the people who own physical metal are going to experience a wealth transfer that will be generational. We are entering the era of the real. Paper assets are going to burn. Fiat currencies are going to be debased into irrelevance. But silver, physical silver, the metal that you can hold in your hand, is going to be one of the most valuable assets on Earth. Subscribe to this channel if you want to survive what's coming. I'm going to keep tracking this story as it unfolds. I'm going to show you the data they don't want you to see. I'm going to call out the manipulation in real time. And I'm going to make sure you don't get shaken out when they come for you. Don't blink. The next 6 months are going to redefine wealth for a generation. Make sure you're on the right side of it.